Doing business in the U.S. means one thing. The IRS will want its share, even if your company's based overseas. Today I'll break down how foreign companies pay U.S. taxes and what you need to know so you can avoid penalties and keep more of your profits. First, what's a foreign corporation? Think of it like moving to a new neighborhood. If your company was formed outside the U.S., but you have an office, bank account, or even a representative here, the IRS treats you as a foreign corporation for tax purposes. Even a company from one U.S. state can be foreign to another state. But for foreign taxes, it's still domestic if it was organized in the U.S. Now, domestic versus foreign corporations. Domestic corporations report worldwide income and file Form 1120 or 1120S if it's an S Corp. The corporate tax rate for a C Corp is 21%, for example. If you file late, penalties can start at 5% a month. Foreign corporations may have to file Form 1120F if they have U.S. source income and pay U.S. income tax on U.S. source income. The rate depends on the type of income and other factors. Sometimes it's a flat 30%, or a lower tax may be specified by a tax treaty. Let's talk about the 5 main types of U.S. income for foreign corporations. Effectively connected income. This is income from doing business in the U.S., like running an office or selling goods here. FDAP, or non-effectively connected income. This includes things like rent, royalties, or payments you get on a set schedule from U.S. sources. Branch income. This is profit from a U.S. branch of your foreign company. It's taxed at 30% unless a tax treaty reduces the tax rate. Subpart F income. This may apply to controlled foreign corporations or CFCs. Example, if U.S. shareholders own more than 50% of the company, they may be taxed on certain types of income, such as passive income or income derived from a related property. Real property income. If you own property in the U.S. and rent it out or sell natural resources, the income can be taxable. Global intangible low-taxed income, or GILTI for short, is most common for individuals who own a foreign corporation. It was introduced in 2017, and it taxes U.S. shareholders on CFC earnings exceeding 10% return on tangible assets, assuming excesses from intangibles like patents or trademarks. Applies to CFCs and SFCs with U.S. shareholders owning 10% or more. For corporate shareholders, the effective rate can be 10.5% to 13.125% after a 50% deduction and up to 80% foreign tax credit. For individuals, the income is taxed at ordinary rates without deduction or foreign tax credit unless you're making a Section 962 election. The one-time Section 965 transition tax, enacted in 2017 as well to bridge worldwide territorial taxation, Section 965 imposed a one-time tax on deferred foreign earnings as of 2017 measurement dates. It applied to U.S. shareholders of specified foreign corporations, CFCs, or those with greater than 10% U.S. corporate owners. Here's the big takeaway. U.S. tax rules for individual owners of foreign companies are tricky and can be very complex. Get it wrong and you face big penalties. Or worse, lose your ability to do business here. At Tax Samaritan, we've helped expats and individual owners of foreign companies stay compliant since 1997. We'll guide you through every form, every deadline, and every rule so you can focus on growing your business instead of stressing about taxes. Click the link in the description to get your free tax quote and protect your profits today.